in the last couple years, free cash flow of the business was obfuscated by one very large pipeline build. So they did effectively an extension of their Gulf pipeline, and this is the first business I will get into in terms of CapEx projects, and that really increased CapEx, reduced free cash flow. That project is ended as of mid 2025, and as that two pipelines continue to come online, there's a real boost in free cash flow that comes from the business. Second, they previously owned a super volatile, super cyclical soda ash commodities business, and that created a lot more volatility in the earnings structure or in earnings power, and that sort of increased the discount rate on the business overall, and that was recently sold, and that sale cleaned up the balance sheet, and it basically created more of a stable, growing free cash flow structure based on the three sort of businesses that are left here. And so, the last thing to say in point three here is that, as this pipeline CapEx declines and these new pipelines come online with take or pay contracts, as this soda ash business is out as of Q2 2025, which again is reduced earnings volatility and delevering, and as they continue to grow free cash flow from sort of, growing earnings from the pipelines, declining, CapEx, and reduced interest expense, you're going to continue to see sort of a flywheel effect of higher free cash flow from continued deleveraging. And so all of this in terms of free cash flow results in something like $2.70 in free cash flow per share in 2027 on a $16 stock. And so, why is the stock still trading at basically a 50% discount to comps? And it's really a function of